You ever hit file on your tax return and feel like you just tipped Uncle Sam for the pleasure of being generous? I know I have. Most of us cut a donation check, feel good for 10 seconds, and then nothing because the IRS just shrugs thanks to that giant standard deduction. But here's the wild part. What if you could slash a six-figure chunk off your taxable income right now, even though your favorite charity won't see a dime until years later? Sounds like a cheat code, but it's completely legal. It's called a donor advised fund. And once you see how this works, you'll understand why the wealthy love it and why you don't have to be wealthy to pull it off. So let's talk why most donations don't count. Let's start with the problem. The One Big Beautiful Bill Act boosted the standard deduction to $31,500 for couples, $23,000 if you're head of household, and $15,750 for singles. That's so high, most folks never itemize anymore. Translation, you're giving out of the goodness of your heart, and you should, that's the point, but tax-wise, it's invisible. Meanwhile, the ultra-rich are setting up foundations and grabbing big deductions today and deciding later who actually gets the money. Sounds unfair, right? Well, the tool they're using, the parking lot for charitable donations, is something you and I can use too. It's called a donor advised fund. So what exactly is this thing? Well, think of it as a charitable brokerage account. You open it under a sponsor like Fidelity, Schwab, or your favorite advisor. You toss in cash, stock, even crypto. The moment it lands, you lock in a deduction for this year. The money inside the donor advised fund grows tax-free, and you can recommend grants to charities whenever you want. Tomorrow, 5 years from now, whenever it makes sense. You're technically just the advisor, but in practice, you're steering the ship and telling where the money is going to go. And if that sounds pretty good already, hang tight, because the tax math behind this gets even better. Why do I say that? Well, imagine something like your RSUs that just vested and your income spikes, or maybe you've done really well in the market. Normally you give $10,000 a year with potentially no tax benefit. But what if you put 5 years worth of giving $50K into a donor advised fund this December? Suddenly you've got $50,000 in itemized deductions. That could mean knocking $17,500 off of your federal tax bill at a 35% bracket. And if you donate appreciated stock instead of cash, you not only get the deduction, you also avoid the capital gains tax you'd owe if you sold first. That's a double savings. This is why people call the DAF, or the Donor Advised Fund, a tax efficiency machine. But don't worry, you don't need a private banker to set one up. In fact, you could do it this afternoon. Well, how? Here's the step-by-step play. Number one, open the account with your advisor of choice. We talked about that a minute ago. And it can often be done in about 15 minutes. It's not that difficult. Then you fund it with cash, shares of stock, or even list it as an IRA beneficiary. Invest the balance inside the fund into index funds, mutual funds, stocks, whatever fits your style. And then number four, grant when you're ready. One tax receipt, and then you can support any 501c3 you like. That's it. Setup is faster in many cases in this video. Now you might be wondering, okay, this saves taxes and simplifies giving, but is there more to it than that? And the answer is yes. Privacy and flexibility that even foundations can't touch. And nobody talks about foundations. Now, nobody talks about this, but a foundation has to file a public 990 that shows to the world every check they write. A donor advised fund, on the other hand, keeps your giving under the sponsor's umbrella. You can stay anonymous if you want, and you only get one clean tax receipt no matter how many charities you support. And that's a huge perk, because sometimes the biggest donation is the one you don't want broadcast to the world. And if that's you, you know what I mean. Now, a donor advised fund isn't magic for every situation. If you want to run your own scholarship program, hold real estate inside the charity, or you're managing $50 million with a staff, well then sure. This isn't the right answer. A private foundation would be better. But if you got appreciated stock or crypto, or even just a big bonus you want to bunch into this year, the donor advised fund is hard to beat. And speaking of real world situations, let me show you exactly how people are already using this strategy. So let's start with a tech employee. He donates $100,000 of stock with a $5,000 basis into a donor advised fund. gets to deduct that full $100,000 and avoids the huge tax bill he would have paid on the capital gains, and then spreads the giving over 10 years while the rest grows. Another example, a giving couple, instead of $12,000 every year, they give $24,000 every other year. That way they itemize in even years and take the standard in odd years. It's called bunching. And they save thousands while keeping the giving to the charity steady, which is one of the things people worry about with bunching, is that the charity won't get the money steady. With the donor advised fund, you can take advantage of bunching, but then you can divvy the money out evenly so that the charity doesn't have to worry about their budgets. Now, what about a retiree? Well, you can name the donor advised fund as a beneficiary of the IRA. So when you pass, maybe it was 50%, half that IRA flows tax-free to the charity, shrinking that tax bomb for the kids. And here's the kicker. These strategies don't require huge wealth. They just require knowing the rules. But like any strategy, there are landmines. Don't wait until January. The funds have to clear by December 31st. And don't send money to GoFundMe. Only IRS-approved charities count. And you got to know the limits. Cash gifts, we're allowed up to 60% right now. Appreciated assets like the stocks we talked about only do 30% of our adjusted gross income. Anything extra carries forward for 5 years, but plan ahead. And don't let your balance just sit in cash. You already got the deduction, now let it grow. Now, if your 2025 tax bill is looking nasty, this is one of the few buttons you can push before December 31st that really moves the needle. Open that donor advised fund, get the deduction, skip the capital gains, and simplify your giving for years. So in conclusion, let's recap. Deduct today. Grow tax-free tomorrow. Grant whenever you want. That's a donor advised fund in a nutshell. It's a rare IRS-approved way to cut your taxes and still fuel the causes you care about. Now, if this just saved you some serious money, hit like so the algorithm gets in front of the next person who needs it. And subscribe, because each week we're helping to save taxes and plan for your future.